Good evening, and welcome to tonight's webinar titled How to Break Free from Traditional Investment Strategies and Supercharge Your Returns. My name is Michael Schmidt, and I'm a principal at Crown Bay Group. Crown Bay Group is an owner-operator of multifamily properties. We specialize in Class B and C apartments, primarily in Atlanta and select markets in the Southeast. Our company was founded in 2013, and since then we have owned and operated close to 4,000 units with a total value of $325 million. We've gone full cycle on over 20 deals, so that's bought and sold. We started our own property management company in 2017 after frustration with third-party management companies, and it's really been our secret sauce to our success. Our management company is led by an industry veteran with over 40 years experience, and we work very closely together with our management company. Our management company only runs our properties for ourselves and for our investor partners. In tonight's webinar, we're going to examine the real performance of the stock market over the last 2+ decades, shine a spotlight on the 4 assassins to your stock market portfolio, and then suggest another option for you to consider: passive multifamily investing. This presentation should only last about 20 minutes. I'll end with a Q&A session if there happens to be any questions. You can type your questions in the chat box. If you have questions about the math, please download the ebook on our website. It has all the backup. So let's get started. Many people have always thought of investing as selecting a basket of stocks and bonds and hoping for the best. The reality is that investment portfolios that focus on just stocks and bonds force investors to compromise, either by sacrificing return for lower volatility or enhancing return at the expense of higher risk. It feels like the crashes in the last 20 years have become more violent and are happening more frequently. And they are. 3 of the last 5 major crashes have occurred since 2000. You can see the dot-com bubble crash in 99 and 2000, the financial crisis in 08, and then the crash that came with the coronavirus in 2020. So millions of people are wondering, how can they possibly plan for their financial future given the uncertainty and volatility in the stock market? So let's assume you invested $100,000 in the S&P 500 from 2000 to 2022. The S&P 500 is the very definition of the market. You would have earned a 7.94% average annual return, including dividends. Not bad. So if you invested $100,000 in 2000, it would be worth $580,201 at the end of 2022, right? Unfortunately, it's not that simple. Assassin number 1, market volatility crushes returns. If you invested $100,000, it would actually be worth $403,203, which is a 6.25% compounded annual return, because year-to-year volatility diminishes compound returns over time. And as you near closer to retirement, this is the riskiest time because your portfolio has less time to bounce back. But wait, fees deal a second blow. Your stock portfolio may have a combination of passive and actively managed stock, mutual funds, and ETFs. Management fees and expenses can range from as low as 0.02% to 3% or more. If you use a financial advisor, they typically charge 1% of assets under management. So let's just assume overall fees are 1%. Instead of being left with $403,203, you would end up with $323,080, which equates to a 5.23% compounded annual return. But wait, assassin number 3, taxes. Capital gains rates are designed to encourage long-term investing greater than 1 year. Long-term gains are taxed at 15% for most tax brackets, but it can go higher. So let's just assume you sold the portfolio in 2022 and owe 15% on your gains. That would push your compounded annual return down to 4.73%. Assassin number 4, it's the silent one, and it's inflation. And that's the knockout punch. Inflation erodes the value of your stock portfolio. The Fed's stated objective is 2%. Over the last 2 decades, inflation has averaged 2.5% per year. Compounded over 2 decades, an inflation rate of 2.5% reduces your after-tax return to 2.59%. So what does all this mean? If you invested $100,000 in 2000, your actual return, so the kind you can actually buy something with in 2022 dollars after you pay fees and taxes, is a measly 2.59%. You managed to save $100,000 of your hard-earned money, invested it long-term as you were told to do, and when it's time to sell, you made just $68,216 in net profit after 23 years, a far cry from your expectations. I don't know about you, but I find that extremely frustrating. So what is an investor to do? Well, the stock market almost certainly deserves a portion of your investment portfolio, but allocating a percentage you're comfortable with to real estate is the answer, and I'll explain why. Real estate is historically the most tried and true way to build wealth. It's fairly easy to understand, tangible, generates income, and doesn't lose value overnight. Many investors who are considering investing in real estate often think of single-family homes. You might get lucky with good tenants, or you might end up with tenants that cause problems. You will have roofs that leak, toilets that clog, tenants that pay rent late, or even worse, you'll have to evict someone. You'll need to hire an accountant to keep the books and have an attorney on call. You can delegate day-to-day affairs to a property manager, but good ones are hard to come by, and their fees will eat at your return, turning a potentially good investment into a less than stellar one. So if you're open to investing in real estate, but don't want the hassle or headaches that can be associated with it, you should consider a real estate investment option that has greater returns, unique tax benefits, is a hedge against inflation, and does not have the day-to-day market volatility. And it's 100% passive. This is a multifamily real estate syndication. So what is the definition of a multifamily real estate syndication? It's where a group of investors pool their money together for the common purpose of purchasing an apartment complex that would otherwise be nearly impossible for one investor to purchase on his or her own. The concept of syndication is actually not new. It used to be available to the ultra-high net worth investors that were in the know. But since the passing of the Jobs Act, any investor now has the opportunity to participate through private offerings governed by SEC rules. So how is a syndication structured? The structure involves a general partner or a GP, sponsor, or operator, and that would be Crown Bay Group, and limited partners, also known as LPs or passive investors. The GP is responsible for finding the right property, negotiating the deal, performing due diligence, securing financing, guaranteeing the loan, raising money, coordinating with the attorneys to create the property LLC and partnership documents, overseeing property management, managing ongoing investor communication, filing taxes, and a host of other things. The LPs are responsible for funding the transaction. In return for their investment, they receive ownership shares in the LLC that owns the property. They receive quarterly cash flow distributions plus back-end profits when the property is sold. Think of it like this. Investors are riding in the sidecar. They get all the benefits of owning a multi-million-dollar property without any of the hassle. There are 5 main benefits of passively investing in multifamily syndications. Strong risk-adjusted returns plus diversification benefits, passive income, appreciation, tax benefits, and it's an inflation hedge. The first one is lower risk, greater returns. Perhaps the best advantage of investing in apartments lies in their risk-return profile. For decades, apartments have had the best risk-adjusted return of any property type, which means they have the highest return per unit of risk. Large apartment complexes have many leases, and each lease represents a small portion of the overall income. This gives apartments a distinct advantage over office, industrial, and retail properties, which have fewer tenants. Apartment leases are typically 1 year. This short-term lease structure gives the owner the advantage of adjusting rents upward more quickly in a tight market, or after making improvements to the property or the units, or lowering them during a downturn to maximize occupancy if necessary. Leases are also staggered throughout the year, so you don't have lease rollover all at the same time, like with other property types. The main reason institutional investors allocate capital to commercial real estate is diversification. A key metric of diversification is correlation, measured by the correlation coefficient. If two assets have a correlation coefficient of 1.0, they have a strong positive correlation. That means they move together. If two investments have a -1, they have a strong negative correlation, meaning they move in opposite directions. If two investments have a 0.0 correlation coefficient, they have no correlation at all. As you can see in the table at the top right, real estate has almost no correlation to stocks, 0.07, and a slightly negative correlation to bonds, -0.15. As such, real estate provides diversification benefits to a stock bond investment portfolio. Next, let's take a look at the table at the bottom right. This is the 20 worst quarters for a 60% stock, 40% bond portfolio from 1978 to 2012. In 17 of the 20 worst quarters for the stock bond portfolio, private real estate had positive returns. So now we know the link between returns to real estate and stocks and bonds is very weak. Lastly, studies have shown that apartments have been the most resilient property type during economic downturns, and they're the quickest to recover. Investing in apartments is investing in the basic need of shelter. People need a place to live, and there's a shortage of housing. As shown in our earlier stock market example, the average stock market returns over the last 23 years was 7.94%. But after taking into account volatility, fees, taxes, and inflation, the return dropped to 2.59%. On the other hand, multifamily syndications routinely deliver double-digit returns, and that's after taking into consideration volatility, fees, taxes, and inflation. The second benefit of investing in apartments is passive income. After tenants pay rent, the general partner pays property expenses and the mortgage, and the remaining cash flow is available for distribution to investors, the LPs. That passive income is fairly predictable for a stabilized property. Generally, as an LP, you can expect to receive a 6% plus annual distribution paid quarterly. Some of our investors that are nearing retirement or in retirement love receiving the quarterly dividends or distributions. The passive income is nice, but the best part is the back-end profit. And that brings us to the third benefit, which is appreciation. An apartment complex is valued based on the amount of money it generates, as measured by net operating income, or NOI. NOI is revenue minus expenses. If NOI goes up, all else being equal, the value of the property goes up. Increasing net operating income is what great operators do best. The end result is a hefty back-end profit for investors when the property is ultimately sold. The combination of passive income and back-end profit is what creates wealth. But there's another boost for investors, and that's tax benefits. Apartments have tax advantages over nearly every other investment, including stocks, bonds, and other property types. The reason is because the government wants people to invest in U.S. housing. The IRS allows apartment owners to deduct mortgage interest and depreciation from the property's net operating income. Depreciation is a huge benefit. For tax calculations, the IRS assumes a multifamily property only has a useful life of 27 and a half years, as compared to 39 years for other commercial property types. We know this isn't true because there are properties in operation that are much older than 27 and a half years. But the IRS allows owners to take a paper loss each year equal to the value of the building divided by 27 and a half. And remember, 27 and a half is for multifamily, and the lower the denominator, the bigger the benefit or the paper loss. This is called straight line depreciation. So let's use an example. If you have a $10 million property and the land value is 1.5 million, then the building value is 10 million less the 1.5, it's $8.5 million. If you divide that by 27.5 years, you get an annual paper loss of $309,000. If your net operating income is $500,000, your mortgage interest is $250,000, and your depreciation loss is $309,000, according to the IRS, your taxable income at the property level is negative $59,000. But your NOI was still $500,000. You didn't actually have a loss, just a paper loss. Another tax strategy is cost segregation or front-loading depreciation. So in the earlier years, the losses are larger, and you can use those losses to offset other passive gains that you may have. So what's the benefit for you, the investor? The result is the investors in a syndication will pay little to no taxes on distributions until the property is sold, which frees up the capital that would have gone to pay taxes to invest in other income generating opportunities. So it's a deferral play. When the property is sold, the investor will pay taxes on the total depreciation taken, which is a depreciation recapture tax, and pay capital gains. But the result is a lower blended tax rate. Do stocks do that for you? No. The last one is inflation. It's an inflation hedge. Inflation is a friend to real estate. Property owners can actually benefit from inflation. Increasing rents, all else being equal, leads to increasing property values. Some people are confused by this one, but do the math. If your revenue increases by 3% and your expenses increase by 3%, your NOI increases by 3%. Lastly, as I mentioned earlier, property types like multifamily that have short duration leases provide better inflation protection since owners can match inflation more quickly by adjusting rents. So what if back in 2000, you would have invested that $100,000 in a multifamily syndication, and when the property sold, you paid taxes on your gains and rolled the remaining profits into another? Let's assume you did that 5 to 6 times through 2022. Assuming a conservative 12.5% compounded annual return after fees and taxes, you would have made $1.4 million in profit, which equates to $737,000 of buying power in today's dollars. Remember, that's compared to just $68,000 in the stock market over the same period of time. It gets better. Remember when I mentioned that one of the benefits of multifamily syndication is passive income? You could reinvest that $1.5 million, which includes your initial $100,000 investment, across several syndications and expect to earn 6% plus per year in distributions, in addition to the back-end profits. So that's $90,000 per year in cash flow, in addition to the $1.4 million you already made in profit. Can you imagine the profit if you would have invested in multiple properties over those 23 years? Meaning you didn't just roll that initial investment into future syndications, but in year 2000 you invested 100,000. In year 2002 you invested 100,000. Year 2004 you invested 50,000. The results would be staggering. I hope you enjoyed this webinar. Your head may be spinning. If so, download our free ebook on this webinar topic and read it a few times. You can find the ebook on our website or watch the webinar replay again. You'll receive that in the next few days. If you haven't joined our investor circle, please go to our website, crownbaygroup.com, and join. You'll be asked to fill out a short questionnaire, then schedule a one-on-one call with either myself or my partner, Steve, so that we can get to know each other better. And I promise it's not scary. After that, you'll get access to future investment opportunities as they come, and you can get on our mailing list. If you are interested in potentially investing in our next investment opportunity, you might want to join our investors circle pretty quickly. We only offer access to future investment opportunities to our Crown Bay Investors Circle members. And that concludes the webinar. Thank you very much for coming. If there are any questions, I will take those now. I don't see any. You can reach me by email at michael@crownbaygroup, or you can schedule a call if you have any questions. And as I mentioned, download the ebook. We have all the math that backs up the calculation that'll be in the appendix. So thank you very much for joining, and we hope to see you on the next one.